Welcome back, investors. Welcome to a new weekly Vinley Radar news wrap-up. This week, as you can already see in the title, markets have been rattled with specific situations related to tariffs of the US Trump administration, as well, of course, the further escalation in the US-Iran situation where nobody really knows what's going to happen. And also something interesting, and I already have been commenting this in the past, if it is on LinkedIn or also on our YouTube channel, is the kind of people and investors being nervous about the number of money that is being invested into artificial intelligence and more specifically data centers. So overall, as you can see, markets have been decreasing versus the previous week. And if you look at macroeconomic indicators as well, there actually the news were pretty positive. If you look at the jobless claims in the US, they were better than expected, and also the new sales of homes in the US were actually beating forecasts, even though you know that I'm not a forecast guy. And then also, of course, next week there is still a lot of uncertainty on the markets, as next week the US Federal Reserve will decide on interest rates. Some people are expecting an increase in interest rates because of inflation, and at the same time with a new chair, maybe that will change. So we'll see what happens next week. Let me start with one of the first companies that I want to cover in this weekly Vinley Radar, which is IBM. Normally, I don't speak too much about IBM. I don't have it in my portfolio, but there has been something interesting happening. You see it immediately here on the Vinley graph that the share price, in fact, has lost nearly 25% in a single day on July 14th, which is interesting because it was a couple of days before the official earnings release. And what has happened is that, in fact, that on July 14th, the current CEO of IBM, Arvind Krishna, has sent a letter to investors, which was like a pre-release note that, in fact, that couple of things went wrong, in fact. And amongst the things that went wrong was how they recognize revenues. So I'll speak about this when I'll speak about forensic accounting in the next slide. But you see that the growth, of course, of IBM is by far not at the level you're going to see the Google results, for example, or the SAP results in a couple of minutes. But of course, the results of IBM were not good. But what was more interesting, what I want to pick out here and call out here, is this one. So actually, the CEO, so if I come back, so Arvind Krishna, what he said is, in fact, that they faltered and that they missed closing mainframe deals for I think it's the Z17 series of mainframes. And I was like, okay, that can happen. But I was surprised by the overreaction of the market, minus 25% in one single day. So I started researching, and I found out that, amongst others, a US law firm called BFA Law is in fact investigating whether IBM committed securities fraud related to misrepresentation of the new businesses related specifically to this Z17 product revenue recognition. So what is, I would say interesting, if I may say like this, is that there is a class action now probably that this company will file against IBM as a company. And I was like, okay, so if they are filing for potentially securities fraud related to misrepresentation of the revenues linked to the Z17 series of products of IBM, I was like, okay, so we are in the space of earnings manipulation, and you know that one of the very first things that I like investors to have a look into before they even think about investing into a company, how reliable are the financials. So I took the tool that we have built for ourselves, which is called Vinley, if you would not know it, and I went into the Danish AMSCO because we do forensic accounting, amongst others, in Vinley when analyzing the valuation of companies and everything that is valuation risk. And what was interesting is that the Danish AMSCO, the aggregator score, was already flagging orange. But I went into the details. So for those who would not know, Professor Benish has created a statistical measure that compares year over year the probability, let's call it like this, of earnings manipulation through an aggregated score. But this aggregated score has 8 subvariables. And as you can see, we have created it like this in Vinley as well. There are 4 variables that could be considered being directly linked to direct earnings manipulation, and the other ones are more like pressure so pressure indicators that maybe management will face pressure to make sure that the results are good. What struck me is, in fact, when you look at the detailed Danish AM score, not just the aggregated, so the aggregated score is at minus 167, which is already, I mean, not a great score. And you see that Vinley is mentioning that it is orange. But what is interesting is when you look at accounts receivables, which is the most easy way to manipulate revenues, is that you book revenue even though you are not sure that you will be able really to be paid for that revenue. And that's the first, so that's the DSRI variable in the Danish AM score. And you see that that one in Vinley is flagging red for the 2025 to 2024 figures. So interesting is that if you would have used Vinley and you would have looked at the Danish AM score, specifically the detailed one, you would have seen actually that something is not going right and not going well on the accounts receivable, which is an easy way of manipulating numbers. Again, let's see what the results of the class action, what the outcome of the class action will be. But again, I mean, I have not invested into IBM, but it would have been interested to look at the Danish AM score. And that's why the very first thing I always recommend to investors, look first of all at the Danish AM score if the financials are reliable. So that's for IBM. Not very good news for the company, actually. Second one is SAP. You see here there is a red label. It's in my portfolio, so I want to just be very transparent on this. So I bought SAP a couple of weeks ago, where the market was a little bit depressed, specifically with the announcements related to Anthropic, Claude, etc. And some of you may have seen that on LinkedIn, for example. I was commenting that if people believe that Anthropic will have an impact on SAP, they don't understand what an ERP system is, and that an Anthropic will never replace an ERP system like SAP, which is the reference ERP system across the world, specifically for Fortune 500 companies and multinationals. So overall, the results were good. So of course, for me, very, very positive surprise. I mean, I do not, I mean, I of course never know how the market, in which direction the market will go, specifically on the stock that I bought a couple of weeks ago. But positive surprise is that the market reacted positively to the company. It was cheap. That was one of the reasons why I bought into it. So yesterday, which was Friday, the market reacted with nearly plus 10% on the share price. And you can see, I mean, if I walk you through the main financials, they have a huge cloud backlog. The cloud revenue has climbed by 22%. Total revenue grew by 9%. The free cash flow jumped by 27%. So overall, very, very solid results for the first half of SAP, in fact. So again, I mean, of course, me as a shareholder, I'm very pleased about this. I will not say expecting this type of growth, but I just bought in because I believe that companies that own SAP is kind of paying a tax for running the ERP system. So an ERP system is accounting, everything that is treasury management, and other modules that just make sure that the financials are correct for the company. And I don't believe that, SAP is the biggest one in that area, and it's very difficult to substitute SAP. So overall, I mean, good surprise or good results for the company SAP, and well done to the management. Next one is Nestlé. Again, here, red label. I do own Nestlé in my portfolio. I bought it, I think it was a rough cut when it was at 79, because, I mean, if you look at the overall over the last couple of years, there have been a couple of issues with Nestlé, but I still believe that Nestlé has a very strong position. So they shared their results, I think it was on Wednesday this week, if I'm not mistaken. So overall, the growth, what they call the real internal growth, was okay. As always, they follow more or less inflation. I mean, these are not companies that will grow at 10% over a quarter. They're exposed, of course, to foreign exchange headwinds, but overall, the results were financially pretty sound. One of the interesting facts is that they announced a 50-50 joint venture with Platinum Equity for the waters and premium beverages business, which means that they're kind of starting to divest to some extent from the water business, where they had also issues in the past with Nestlé Waters. And so to focus on things like Nespresso, for example, or Purina, which is pet food. So there, in fact, if you look at the report, the results were pretty good, in fact. Nonetheless, the market reacted negatively. So I think it was on Thursday, the stock lost minus 6.5%. And yesterday, Friday, actually, it recovered already by 1.8%. So overall, I mean, Nestlé is still weak. When you look over a 3 to 4 year period, Nestlé's share price has really dropped a lot from 120, 130. Again, it's, my apologies. Again, it's a big position I have in my portfolio. And I consider that the company has strong brands, so I consider that it will come back. As always, never solicitation for you to buy. I'm not here to give you any financial advice, but just sharing very transparently and honestly how I feel about the company, considering the solid financials, also the dividend that you get from Nestlé, in fact. Next one is Tesla. So Tesla, in fact, had very good results. When you look at the amount of car shipments, was really huge. The amount of deliveries that they provided over the last quarter. Operating margin was not really great. And of course, there is some conversation also on AI related to Tesla. As you know, I mean, part of Tesla, you have also a lot of compute power that is related to it. And so the stock took a hit. So minus 12% was the reaction. You see it here. And so what I wanted to share here, you see here on the graph, I wanted to share just the relative valuation, not looking at absolute valuation, but if you look at the relative valuation of Tesla, the price to earnings and price to free cash flow that you would pay today for Tesla is still huge. It has a PE of 265. That means that at current earnings, you would pay 265 years of earnings, which is crazy high. So again, as always, never solicitation for you to buy or to sell. I just consider that Tesla is still, in my opinion, overvalued. But on the other hand, I have to say, I mean, kudos for the amount of vehicles that they have shipped in the last quarter. I think this is the last company I'm gonna cover this week in the Vinley Radar. It's Alphabet. So Alphabet, what is interesting is that their revenues are really strong. So revenues went up by 24% year over year. They have very strong growth on Google Cloud, by the way. And I have to say, I mean, when you look at the Google Gemini product, because a lot of people were worried about Google, because, I mean, let's be honest, the cash cow of Google is the search box in google.com, and a lot of people were like afraid that this would go away, but they were very smart at integrating Google Gemini in the results of the Google search box, and even myself is something I really use a lot. So I think that there actually they made, I mean, they took the right decisions, so well done by Alphabet. Why did the stock dip? Because of, again, Capex, so capital expenditures on data centers and AI related technology. I'm going to show this to you in the next slide. There is an interesting perspective that also you can analyze in Vinley. But what is interesting here is, I mean, if you look now at, for example, relative valuation, like the price to earnings, you see that it is close to below 15 on earnings. But you see that the free cash flow is red. That's the reason why some investors are unhappy currently about Alphabet, so Google, if you allow me to use the shortcut as Google, because they are spending huge amounts of cash in investing into data center and AI capacity. But if you look at earnings, it looks pretty cheap actually for the time being, and you know that my very first threshold on relative valuation is below 15, and of course better even below 10. So you see that it's orange in Vinley, so it says that price to earnings is at rough cut 16. So to be monitored. I have to be very fair about this. I also looked at absolute valuation. So for those who have a Vinley Plus subscription, you can of course see all those absolute valuation numbers. And what is interesting, when you look at the last price, which was $319 a share, that actually the intrinsic value on discounted future earnings, not on cash flow, because on cash flow, as said, the company has been spending now huge amounts of cash on AI and data center investments and compute investments, but you see actually that the discounted future earnings is above the current share price, only by 4%, so please pay attention. I always say you need to have something like 25 to 30% of margin of safety. And of course in Vinley you can adjust your growth, your cost of capital assumptions. This is the out-of-the-box sensitivity analysis done by Vinley. But interesting too. I would say Alphabet is definitely a company I will be monitoring over the next weeks to see does it recover, or are investors still nervous about it, and again, never solicitation for you to go buy or sell the company, but it's definitely something that I will be having on my list of companies that I will be monitoring. What is interesting, and I just wanted to show this to you because, I mean, this is already a little bit more advanced, but it's something that we have created in Vinley. So I learned the cash circulatory system by following a Harvard Business School lecture. And what I found very interesting is to, in fact, to analyze how capital is allocated. And what is making investors nervous on Alphabet is you have on the left hand side the quarterly view, and on the right hand side the annual view, the last 12 months, the trailing 12 months. Just look at two things: the amount of debt that increased a lot. So you see that the amount of, I mean, they have very low debt. They have huge cash positions. So Google, so Alphabet is not a company that will go bankrupt anytime soon. What is making investors nervous, and I will just take here the 12 months trailing, if you see my mouse moving, is that they are spending huge amounts of cash investing into data centers and AI and compute capacity. This is what you see here. And also at the same time, they are raising debt. So of course, by doing this, let's call it the financial health of the of the company is a little bit, I mean, it's not as good as 12 months ago, because they're investing, they're making bets on the future. And that's the reason, if I come back to the previous slide, that's why, I mean, if you see here over the last weeks where the share price dropped nearly by, let's say, rough cut by 25%. And this is the reason. So if you analyze the cash circulatory system on a quarterly and even on the yearly view, or the 12 months trailing view here in Vinley, you're gonna see in fact exactly what is the reason why investors are getting nervous. Of course, it's a bet. We will not know what the outcome will be, but they are of course betting on AI. So let's see. As said, for me at least as an investor, and again, not an advice for you to buy or sell, but I was surprised to see that price to earnings are at nearly 15, which is my first threshold. And I see here that I already have now at the current share price a 4% margin of safety with the current growth rates. So keeping this in mind, let's see what the future will tell us over the next couple of weeks and months for Alphabet, so the holding of Google. So I hope that you like this weekly Vinley Radar. As said, I try to cover 5 companies as always that are interesting, always in the top 100 of the global companies in the world. If you enjoyed this week's radar and if you want to support the channel, feel free to subscribe to the channel. Please like this video. This will of course help us and motivate us to continue further doing this weekly Vinley Radar. With that, thank you very much and enjoy your weekend. Thank you.